Hello, everybody, and welcome to the Light Investor. This is your home for economic and financial education. And today we are without our good friend and colleague, Mike Mahoney, who's on special assignment. We know where you are, Mike, but not everyone else does, but you're on special assignment. Well, today we've had quite the day, and fear and panic has returned. So we want to put together a quick show, a very important show for you to understand what's going on, why it's really important not to panic, and give you some good data. So as you do hold on during this tough times, you can kind of get a good picture and really just don't feed into all the fear that's taking place out there. So first off, I want you to just think about life in general, or what life is like for a person who buys and holds on to an asset for a long period of time. Today, the younger generations, like Generation Millennial, call this concept hodling, HODL, hodling, hold on for dear life. And some people think that as you hodl, you're going through this easy peasy time period where you reach your financial goal without any type of tough, rough patches. But in actuality, I love this little cartoon here. What actually is it like to hodl or to reach any goal or like a financial goal in life is that you have to walk through deserts and go through trenches and, icy paths. It just doesn't happen. Stay focused, keep your plan, be determined to reach your goal, because if you talk to anyone about how the world works, and even the world of finance, you know that people come out with battle scars and wounds, but they can make it to their end goal. It just takes a little bit of effort there. And so when it comes down to, I guess today and what we've been seeing in the markets, this fear returning, is that we are actually in the first correction territory that we haven't been there for over a year now, right? 2021 was sort of an exceptional year where the S&P 500 and other indices didn't go down more than 10%. But take a look at this slide here, asset prices in correction territory. You can see that we're looked at the percentage change today at about 1 o'clock on January 24th. How was the S&P, NASDAQ, Russell 2000, and Bitcoin faring? And then look at it, how they were faring for the percent change from their recent high. So the S&P, you can see it's down 2.5% today as of this afternoon, but you can see that overall now we're actually in a correction territory above 10% down. NASDAQ over since its recent high down 16.6%, Russell 2000 down 19.3%, and Bitcoin has lost 50%. Well, for all those people that buy and hold, those holders out there, take a look at a 10-year time horizon for those indices. You can see that the overall equity markets, you are tripling, quadrupling, more than doubling your return. And with Bitcoin, kind of a very risky asset, has seen incredible rates of return. What we don't want you to do is get caught up in trying to time the market. It's hard to get in, and then it's hard to know when to get back in. It's hard to get out and to get in as well. So meet Kevin. Is a famous influencer. I guess Ryan would say he's an influencer, right? He has 1.8 million followers on YouTube, much more than the Light Investor at this point. We're coming for you, Kevin. Kevin has decided to sell all the stocks on Friday. So think about that, folks. He lost, the markets went down for many, many weeks. He sold as the market was going down, and now he's got to decide when he's going to get back in, plus pay all of the unrealized gains on his taxes. And living in California, that could be like 50%. So whenever you do exit the market, know that it's hard when you get out and when you get in. It's kind of double hard to do this. The other thing I wanted to talk to you a little bit about is like, why do these panics occur and manias occur? I mean, some of these people that are following Meet Kevin are going to go along with him. And here in Peoria, we have a famous bridge called the Murray Baker Bridge over Peoria Lake, it's called, on the Illinois River. And that must be home to a few pigeons. And every once in a while, you see these pigeons, they start flying away, they fly in the air, and then they come back down. They all herd together like a herd animal. And I think this is, this is what happens to people. Burton Malkiel, the famous author of A Random Walk Down Wall Street, has this idea called the pigeon investor theory. And it just states that people follow each other rather than fundamentals, and they can follow each other off cliffs and sometimes up the mountains, but sometimes off cliffs as well. So I think in many ways to be a fundamentally sound investor is that you're buying all the time. You're buying when it's low, you're buying when it's high, and dollar cost averaging in and holding, right? So today's been kind of a rough day, and I know that I feel it too. It doesn't feel good to see your assets decline. I have financial goals just like you, and there's some particular reasons why the market's been going down. We call these negative catalysts, right? These negative reasons for concern. And the first one here, I have a picture of Chicago and a storm's coming out, these dark clouds, the FOMC dark clouds. I think we all know that the United States is in a period of higher elevated inflation. And the Federal Reserve is going to meet this week coming up, and they're going to talk about raising interest rates, or at least perhaps tapering. So what the expectation is the Fed will not raise rates until later on in March. And so some people are maybe getting ahead of themselves thinking that they might raise now. So assets generally have a negative impact when interest rates go up. They generally is a headwind to it. And so I think people are pricing in these higher rates right now. And that's one of the negative catalysts we're starting to see. The second catalyst is kind of an unexpected one. We talked about this one in an earlier video, and that is like these external shocks that could occur. And today we learned that the Biden administration is considering putting in 5,000 troops into Eastern Europe to kind of combat the Russian aggression toward Ukraine. And that's kind of got people and markets in a panic. And so that's why we saw the Dow drop over 1,000 points earlier today. So anyways, there's always going to be these issues of external economics. But there's three key takeaways for today. And I'm glad you stuck around to the end of this video. Because I have a quote here from our buddy Mike. He says, "Short-term volatility is a natural part of investing. As hard as it may sound, long-term investors should embrace volatility because they can accumulate more shares when prices are lower, and it affords them greater likelihood of higher returns in the long run." So thanks, Mike, for that. But the second one is don't panic. It doesn't feel good at the time. We're living through this as you are as well. But the key is to hold on. You have a goal. It might be 5, 10, 15, 20 years. If you sell now, you're having all the negative consequences of selling at low prices and all the tax consequences if you're in a non-IRA account. So hang in there, folks. The last one is, and I have one more slide on this one, is that time in the market is more important than timing the market. The longer that you are in the market, folks, the less risk you take. Think about that. The market has returned 16 positive years out of the last 20. And also think about this. When the stock market goes down, risks are actually declining for each individual asset. And when stocks go up, each return and risk is higher for each individual asset. So definitely hang in there. So it's hang in there. And this last slide is looking at the rates of return over the last 20 years of the total stock market, and also the worst negative intra-year decline. So I'm going to take you back. We don't have a number for last year on this particular slide. This comes from Dimensional Funds, DFA. And in 2020, take a look at that, folks. At one point in time, the overall total stock market index was down 35%. But if you just held on throughout the whole year, you would have been up 21%. Incredible. And then in 2019, you would have been down 7% at the worst time in the year, but you were up 31. Now, there are negative years, like in 2018, you were down potentially 20 at any particular point, but overall, you're only down 5. So again, the key takeaway is the time in the market, you will be rewarded, okay? You're betting on the United States economy and the productivity that is taking place. So Again, folks, I guess I wanted to kind of give you a pep talk today to hodl, hang in there, and we're with you here at the Enlightened Investor. Feel free to smash the like button if you enjoy this content, and you guys have a good day. Hang in there and let us know if you have any questions. Take care.